Imagine being able to turn the value of your home into a pile of cash you can use right now without selling it. Sounds tempting, right? But here's the twist. It could either set you up for years of financial comfort or trap you in a costly mistake that takes decades to fix. And by the end of this video, you'll know exactly which side of that line you're standing on. So let's break down if a cash-out refinance is the perfect move for you or a dangerous detour for your finances. Number 1. What exactly is a cash-out refinance? Think of your home like a piggy bank. Over the years, you've been stuffing coins into it through your mortgage payments, building what's called equity. A cash-out refinance lets you smash open that piggy bank, replace it with a bigger one, and keep some of the coins for yourself. Here's how it works. You take out a new mortgage that's bigger than your current one. You use part of that money to pay off your old mortgage, and the rest comes to you in cash. For example, if you owe $150,000 on your mortgage but your home is worth $250,000, you might refinance for $200,000. You pay off the old $150,000, and you walk away with $50,000 in your pocket. Sounds easy, but there's more to it than that. Number 2. Why people choose it. People use a cash-out refinance for different reasons, and some are smarter than others. One of the most common, home improvements. A new kitchen, updated bathrooms, or an energy-efficient roof can increase your home's value and your comfort. Another reason is debt consolidation. If you have high-interest credit cards charging 20% interest, replacing that with a mortgage rate around 6% could save you thousands. Some even use it for education costs, investing in a business, or covering medical expenses. But here's the catch. Just because you can use it for almost anything doesn't mean you should. Number 3. The hidden costs you might miss. A cash-out refinance isn't free money. You'll pay closing costs, which can range from 2% to 5% of the loan amount. On a $200,000 loan, that could be anywhere from $400 to $10,000. You also reset your mortgage term. If you've been paying your current mortgage for 10 years, refinancing into a new 30-year loan means starting over. That's like running a marathon, reaching mile 20, then deciding to go back to mile 1. And don't forget, the bigger your loan, the bigger your monthly payment could be, unless you stretch it over more years. Number 4. How to know if you qualify. Lenders look at 3 main things: your credit score, your home equity, and your debt-to-income ratio. Most want you to have at least 20% equity left in your home after the cash out. So if your home is worth $300,000, you might need to leave $60,000 untouched. Credit score requirements vary, but a score of 620 or higher is common for conventional loans. Higher scores can mean better rates. Your debt-to-income ratio, which is how much you owe compared to how much you earn, usually needs to be under 43%. Number 5. The smart way to use it. Here's the golden rule. Only use a cash-out refinance for something that improves your financial future. If you're renovating your home to increase its value, consolidating high-interest debt, or funding education that will boost your income, that's a good sign. But using it for a lavish vacation, a car that loses value the moment you drive it, or shopping sprees, that's a fast track to regret. A friend of mine once used a cash-out refinance to fund a new business. He calculated the risks, built a solid plan, and within 5 years, his income had doubled. That's smart use. Another friend, she used it for a luxury wedding. Beautiful day, sure, but she's still paying for it years later. Number 6. The risk you can't ignore when you do a cash-out refinance. You're turning unsecured debt into secured debt. That means if you can't pay, the lender can take your home. If you use that money to pay off credit cards but then rack up new credit card debt again, now you have 2 problems: no cash and a higher mortgage balance. And if home values drop, you could end up owing more than your home is worth, something called being underwater. During the housing crash in 2008, many homeowners faced foreclosure because they had taken too much equity out and their home values plummeted. Number 7. Comparing alternatives before you decide. Before you jump into a cash-out refinance, compare it to other options. A home equity loan or a home equity line of credit, often called a HELOC, might offer more flexibility or lower closing costs. Personal loans might have higher interest rates but won't put your home at direct risk. And sometimes, the best option is to tighten your budget and save over time. It's less exciting, but it's 100% safer. Number 8. Timing matters. Interest rates change all the time. When rates are low, a cash-out refinance can make sense because you might lower your overall mortgage rate while getting cash. But if rates are high, you might end up paying more in interest for the life of your loan. You also want to think about how long you plan to stay in the home. If you're moving in a year or two, the closing costs alone might outweigh the benefits. Number 9. How to avoid regret. Ask yourself these questions before signing anything. Do I have a clear, disciplined plan for the cash? Will this improve my long-term financial position? Can I comfortably afford the new monthly payment, even if my income drops? If the answer to any of these is no, that's your warning sign. Remember, the bank doesn't care how you spend the money, but your future self will. Number 10. The step-by-step process. First, check your credit score and calculate your home equity. Second, research lenders and compare interest rates, fees, and terms. Third, get pre-approved so you know what you qualify for before you start making plans for the cash. Fourth, gather documents. Pay stubs, tax returns, bank statements. Because lenders will want proof of income and assets. Fifth, complete the appraisal. The lender will send someone to value your home to confirm your equity. Finally, close on the loan. That's when you sign the paperwork, pay closing costs, and get your funds. Number 11. How it affects your taxes. A cash-out refinance is not considered taxable income because you're borrowing against your home's equity, not earning money. However, the interest you pay on the new loan is only tax-deductible if you use the funds to buy, build, or substantially improve your home. If you use the money for other purposes like paying off credit cards or funding a vacation, you can't deduct that interest. This is a detail many homeowners miss, and it can make a big difference come tax season. Number 12. Impact on your home's future sale. When you take equity out of your home, you're reducing the amount you'll pocket if you sell later. If the housing market drops, you might not have enough from the sale to cover your mortgage balance. For example, if you cash out and your home's value falls by 10%, you could walk away with little to no profit at closing. This can affect your ability to move, upgrade, or invest in another property. Number 13. The emotional side of it. Money in your hand can feel empowering, but it can also tempt you into spending without discipline. A sudden lump sum can make you feel richer than you are, leading to quick, impulsive decisions. It's important to separate excitement from strategy and remember that this money isn't a gift. It's debt you have to repay. Number 14. Lender incentives you should watch out for. Some lenders might push cash-out refinances more aggressively because they earn fees from the transaction. They might present it as the smart option without fully explaining the long-term costs to you. Always get a second opinion, preferably from a financial advisor who isn't making money off the deal. Number 15. The psychological trap of lower monthly payments. Sometimes, lenders will extend your loan term so your monthly payment looks smaller. While that might feel like a win, it often means you're paying far more in interest over time. A payment that's $200 lower each month might cost you tens of thousands more over the life of the loan. Number 16. How your loan-to-value ratio matters. The loan-to-value ratio compares how much you owe on your home to how much it's worth. The lower your ratio, the better your chances of getting approved and securing a good interest rate. Taking too much cash out increases this ratio, which could mean higher rates or even loan denial in the future if you need to borrow again. So, is a cash-out refinance right for you? Or will it become a decision you regret? It's a powerful tool when used wisely, and a dangerous trap when used recklessly. If you had access to $50,000 from your home's equity today, what would you honestly use it for?